And good morning, everyone. John Hutchinson with Traders Reserve. Welcome to Breakfast Club here on June 9th, 2025. Jeff Wood is on vacation today. He will be back next week, and we will get his take on sector analysis and other fun things to learn. But I have plenty to share with you today. We'll be walking through some economic data, last week's income report, and I'm also going to take you out and do a live stock screening as I've found something interesting that I want to share with you as it relates to some stocks that you can put in your basket and look to trade either as a stock trade, or potentially for selling options. To get underway, move. Thank you. There we go. Economic data coming up this week. The most important day will be Wednesday, as that will be Consumer Price Index (CPI). Although that is not the preferred metric that the Fed uses to set interest rates, that would be the PCE, or Personal Consumptions and Expenditures. Good God, they need better names for some of these reports. CPI is going to be important because, much as I alluded to last week with earnings, this month's CPI will be essentially a first full month's look at any impact, if there is any impact, on inflation from the universal tariffs, the 10%, and subsequently any of the really the reciprocal tariffs on China, Canada, Mexico, by and large, those three countries. So the expected number is an increase in CPI from 2.8 to 2.9%. So 2.9% is essentially the target. That's for core CPI. The headline year over year was expected to move from 2.3 to 2.5. That's taking into account everything, but the number that matters is on the core CPI, that number does not go above 3%. If that number goes above 3%, we will likely have some volatility back in the market. But as long as it stays at or below, excuse me, at that 2.9%, or even if it comes in flat, market should more or less look past that report. But nevertheless, it will be a critical one. Uh, Later this morning, we have consumer inflation expectations, which is also tied to the preliminary University of Michigan Consumer Sentiment Report. I point that report out. The preliminary report comes out this Friday, but the U of M Consumer Sentiment Report, dating back to February, has been one of the key drivers of volatility over the last 3 months. It was in early February, excuse me, late February, when the consumer sentiment report surprised significantly to the downside. That trend continued through March and April. It reversed in May. So this will be our first look at any change or reversal or no reversal from May to through the rest of May into early June here. The final report will be released. I believe it's in the third week of the month, but I'm not checking the calendar right now to find that out. Along with CPI, we also have Producers Price Index. Prices on from the ISM reports, which were released recently, have been rising. So it is a potential roadblock in the market, with the S&P back at 6,000. This is a busy week, and some of these will have the potential of either moving the market past 6,000, or pushing it back lower. Now, I'm not talking about thousands of points or hundreds of points lower, but that remains to be seen. But the PPI is expected to rise along with CPI. So those two data points this week will go a long way to giving Wall Street uh, tea leaves, crystal ball for what the Federal Reserve will do next week when they, is it next week? Yeah, it is next week. When the FOMC rate setting meeting takes place. Obviously, increased pressure on Jerome Powell to cut rates, but the data is not going to support that. And in the last meetings that the Fed has held, they continue to largely direct the market to a potential September rate cut. Um, Powell's a dove, so you know, keep that in mind. He wants to move interest rates lower, but um, the data isn't supporting that. And as the Fed has continued to work against the fight to get inflation down to or toward 2%. They have succeeded. They have not put the economy into a recession, one of the rare times in history that that has ever happened. But there are some cracks. You do want to be aware of them and keep up on them. So let's take a look at some other information, because this is one of the things that bears watching right now as it relates to the monthly jobs report. The monthly jobs report came out on Friday. Positive 139,000 jobs created in the month of May. But we've had 4 consecutive months of downward revisions, and those revisions are getting larger. To understand what I mean and the in the weeds on the revisions, when the BLS reports jobs the first time, it is based on a survey of a select group of households and businesses, if you will. The BLS then performs 2 revisions to each individual month. So there's revision 1 and revision 2. So next to the months here, if you can see the little superscripts 1 or 2, that tells you how many times those numbers have been revised. And we'll go to February for a moment. The first revision for February reduced the number of jobs that were initially reported by 15,000. The second revision increased that number to 34,000. In March, the first revision was 48,000 jobs lower. The second revision increased that to 65,000 fewer jobs. So, in other words, the March number was originally reported as 228,000. The first revision reduced that to 175,000. The second revision reduced that even further to 157,000. So, and the April jobs report, which was 177, has already been reduced by 30,000 jobs. The I'll put this in a different context and understand this. Revisions to jobs report, not new. There's no conspiracy theory here. But when the BLS, when the initial surveys are coming out um, way too rosy and the actual numbers are significantly lower, that's a trend that you need to pay attention to. It is and it has been one of the Fed's objectives to slow the rate of hiring and to slow the rate of wage growth in the job market. They have largely been able to do that. But if you if or when you see a rapid acceleration to the downside of those numbers, that starts to change the math around the employment market. Employment market has largely been stable. Um, to give you a comparison on this, and this is what I mean by this is not a conspiracy theory, right? This is not something that's just happening in this in this uh, administration. It's not intended that way. If you go back to last summer, preceding last or the months of last summer, you can see there were rising revisions to the June, July, and August jobs reports, and those revisions were equally significant to what we've seen in the last 3 months. And if you look at the chart from last year, you can see that the slowdown in jobs growth was one of the factors, not the only factor, which drove markets lower in the July August timeframe and the September into October timeframe. Now, all of that was pre-rate cut. The Fed, when the Fed initially cut rates 0.5% last fall, most of the summer was spent expecting rate cuts that they didn't get. So that was another factor. But the rapid slowdown in hiring, especially pre-election, was unquestionably a key contributor. And then as we got out of the election, the November and December jobs reports actually had positive revisions. Over 100,000 more jobs actually added than were reported. So remember, revisions are the jobs report is more volatile than people actually expect. And when we take a step back and we sort of listen to the market narrative, if you've heard this phrase, no hire, no fire, this is showing you in data what that means. So last year, for the full year of 2024, the adjusted, for the full year, the adjusted monthly average in jobs gain was 166,000. This year to date, not adjusted, not fully adjusted, it's 125,000. That is a 24% decrease in average monthly job growth year over year. Now, unemployment is holding steady at 4.2%, so that's a key factor. What we don't want to see is unemployment suddenly begin to rise between 4.5% and 5%. That would imply that we are no longer in a no hire, no fire. We are in a no hire and fire market as it relates to labor. But what I am seeing in weekly jobless claims, if you think of this in terms of a stock chart, are higher highs and higher lows in the weekly jobless claims. That means that the lower numbers are the ones that matter. We're not reverting to significant lows as we did throughout last year. So again, a trend that bears watching. This is not uh, it's not an alarm bell yet, but we need to keep our eye on both weekly jobless claims, the jobs report, and those revisions, because collectively they start to tell a different story than what is being told about the employment market. And when we get to the stock screening, there's another trend developing at the consumer side, which I think bears, it's either bullish or bearish. It could go either way, but it bears watching. And it's one of the things that this past weekend while looking through all of this data, barf, um, that I started to think, okay, what's really happening to consumers? And it's, obviously the last few months, everything has been thrown into, torn asunder, call it that, right? It's been, nobody knows what's happening, etc. So the keys to this are the job market is ultimately going to determine soft landing, recession, growth. One of those three things will occur. Right now, we're still trending towards soft landing. Nothing significantly yet implying hard landing. However, what worries me right now with the market back at 6,000 is Wall Street ignoring bad news. This is the ISM Services Index reported month over month. And we can see from February through May, a downtrend developing in the services index. For as Jeff has reported in his writings around for us for at Traders Reserve, the 50 line is the critical line. Above 50 is expansion. Below 50 is contraction. Last month was the first reported contractionary month for services for the services sector since June of last year. So that is the development or the first data point of a negative sort. Now Wall Street looked past that report, and here's why: because the index came in at 49.9, 1/10 of a point below 50. So I understand why Wall Street would sort of give this 1 month a pass. If that trend continues into June, into July, then it becomes a serious trend which Wall Street will pay attention to. But again, with keep in mind, volatility is not limited to the stock market. It is expanded now to businesses, to big corporations, right? The mega companies, all the way down to small businesses, right? That level of uncertainty, and it is also extending out to consumers. But as it relates to where the market's going to go, this is another data point that we need to start building into this broadcast on a regular basis so that we can keep you ahead of any potential trend. Right now, again, I would say this is flashing yellow, not red. Um, but taken together with the decrease in the labor market, it's becoming a brighter yellow to me. Some things to watch in terms of the S&P 500 levels. Uh, Again, we've traded back to 6,000. I think the market is slightly positive, or at least through the end of Friday, it was slightly positive for the year, um, like 0.5%, 1%, something along those lines. Uh, the, the the key levels that I'm marking out right now, uh, a strong support line right around 5,800. So if anything does transpire this month, don't be surprised if the S&P pulls back and retests that 5,800. It's had pretty solid support dating all the way back to November of last year. You can see that on the on in the hey, let's draw. You can see that in this space here. I just need the tool. Thank you. Right, pretty solid resistance and support line there, and it held up here. It held up for a little bit of time there, acted as resistance again, broke through, and it is now largely sat along that line through multiple trading days in May, trading weeks in May, excuse me. This is a weekly chart, by the way. I use that for simpler view. We can see our new resistance line is going to be up here, right around 61.75. So at the moment, I've marked out a high projection of 62.10. That is if earnings stay in or around the 270 level and the market trading between 22 and 23 times forward earnings. That should get us potentially another 3% higher. The downside risk, however, is pretty extreme again. I have that down here running along this. You can see this stretch from March of last year through the current year, that 52, 55, 50 line, prior resistance, prior support, support here, more or less support there, right? Broke through, but came right back up. So these are key levels to watch. One of the reasons I point this out and I'm looking at this is in next week's session, I want to add a little bit of hedging to the downside for you. So Jeff and I will work on that over the next week. But for the moment, that is what I see. We have to ask ourselves, while we know that Wall Street will get out in front of itself, what is the engine that drives the market higher? Um, in July, it would have to be earnings, and earnings would have to be much better than expected against the backdrop of companies that have lowered guidance or removed guidance. So we have some uncertainty coming into the July earnings period. If July earnings are much better than expected, this market can certainly go higher and increase both EPS estimates for this year and for next year. That will give the market, the S&P, room to run up to 7,000. Right now, I'm not marking that out, but it would certainly give it that potential. The downside, of course, is if those earnings miss expectations broadly for the broader market in the S&P 500. I would not be surprised at all for us to see us retest in stages that 5250 line. And it wouldn't be a bad thing. It would, again, allow the market to reset expectations, um, reset valuation, and ultimately be able to rebuild a true bullish market, uh, given known circumstances. Now, the wild card, of course, is tariffs. We have key dates in early July and again in August. In early July, I think it's July 8th, the 90-day pause from the original reciprocal tariffs minus China is set to either be extended, more deals announced, or lapse. I don't know which of those it will be. And then again in August, we had the reduction and pause, so to speak, of the tariffs with China. So we'll see what transpires over the next 2 months. Again, unknown, known, unknown, which is okay. At least we know what we don't know. So any positive momentum on tariffs can change some of the math. But again, that first quarter of both uh, business data, earnings data, here we're starting to see impact to inflation, how that carries out through the second quarter, from April, May, June reporting periods, right? So by the time we get to July, we're really going to have a better sense of momentum in the market. Is it higher? Is it flat? Is it lower? I can't give you a read on that just yet, but I'll keep digging, and eventually I'll have a plan and an idea for you on that front. Turning now to the weekly income report, expanding a little bit, reporting our income from trading, our trading programs last week. Just as a program note, I do not include the options player workshop in these reports. Emily did a terrific write up on uh, some of the big results that Mark A. Latimer provided people in that workshop last week. The reason is it's not a continuing program at Traders Reserve, and we do still report on its progress each week on the tradersreserve.com website. I would also, uh, for folks who need to know about the newest uh, Greek that Dave shared with Income Masters members last week. It is provided in a little bit of humorous context, but it's worth a read today as Emily did a really nice story around Dave's explanation of that. So, that being said, let's take a look at where we are for last week for Income Masters, the week ending June 6th. We closed 7 trades. The average days in trade was elevated to 19.8 days. That was driven by, excuse me, a long recovery trade in Novo Nordisk, stock symbol NVO. That trade lasted 76 days. When I take that one trade out, just as a read on what transpired over the true period of time, our average days in trade was around 9. So that one trade had a pretty significant impact on lengthening the average days in trade. Not critical, not a disaster. Fortunately, closed that one with a profit, a whole $99. Um, Total capital used for the 7 trades, 22,974. Net income, $965 for a 4.2% return on capital for the week. Perpetual income also closed call option on Southern Company, stock symbol SO. So that's outside of these reports. That's an additional $92 in cash for those who are following that stock longer term. We put 6 new trades on using NVIDIA, uh, NVDA, stock symbol, Lockheed Martin, stock symbol LMT, the Van Eck Semiconductor Index, SMH, the Spider Gold Index, GLD, Humana, and Palantir. We also added put and call positions on 2 of our perpetual income holdings, Occidental Petroleum, that's OXY, and CF Industries. 3 positions were rolled last week: VRT, Vertiv Industries, Lululemon, which is turning out to be a lemon, and Constellation Energy Group, CEG. So if you're, as an Income Masters member, remember today at 12:30, you'll have your week's preview, market preview, and position analysis, right? What's trading? What are we trading this week? So make sure that you're up to date on all of the trades from last week and either rolled, opened, or closed any of those positions that were mentioned. Those of you who are looking for stock ideas, there's a list. For the Income Madness event, included in those results that I just shared with you for Income Masters were 2 positions which were closed: Coinbase, that's COIN, and Micron, stock symbol MU. Both of those closed positively for a total of $324. So for the May event, the May 19th through 22nd Income Madness event, we have now closed 11 trades to date. Total income from those trades, $1,682. We have 2 positions remaining open on United Rentals and Tesla, with approximately $4,200 capital still in play on those 2 positions. For those of you in Millionaires Trading Club, it was a boring week. No trades closed. We still have 4 open positions. The capital represented for those positions, $11,062. The 4 positions are in Berkshire Hathaway B class, BRKB, the Spider Oil and Gas, XOP, MicroStrategy, stock symbol MSTR. I always get that one confused with Monster Beverages, so make sure you know the difference in the symbol. And the S&P 500 Index and SPX trade, separate from our SPX1 trade. So that SPX trade is still open. A 5K challenge closed, I believe it's final position as we migrate that service into Millionaires Trading Club. So MongoDB, stock symbol MDB, closed with a $90 gain on about $1,200 in capital, a 7% return in 13 days. And I have not included those the 5K returns. I'm only focused on the Masters and Millionaires Trading Club for the most part. But continuing our February 20 recovery trade update for the SPX1, we succeeded in widening the gap between the put and call spreads on this recovery process. We added $1.80 or $180 per contract, a total of $1,080 across six contracts last week in net premium. Despite having to roll that call spread, could use a breather in the market, uh, something to pull the market back down in between that 5,900, 5,850 level briefly, uh, so that we can start to exit this trade or wind this trade up hopefully by the end of this month. But overall, we're still holding on to about $2,680 in net retained income, accounting for previous loss on two contracts that were closed, or $13.55 per contract right now. So we have some cash to work with on a per contract basis uh, as we finalize or try to end this trade before the end of the month. Combined for the full week, not a truly exciting week in total closeouts, eight trades, $2,130 in net income on 30,974 in capital for a 6.8% return on capital for the week. And across the 2 weeks that since we started broadcasting the weekly income report on Mondays, we've closed 27 total trades, $4,673 in net income on 72,000 in capital for a 6.4% combined return over the last 2 weeks. So overall, averaging right now about $2,300. We had a bigger week last week than we did this past week, 2 weeks ago, excuse me. Some sideways momentum would be welcome, even a little bit of a pullback, so that we can continue to close out additional positions as the week progresses. All right, that's I don't think I had anything out of stock ideas. So let's move along to, I may be a little longer with you this today. So bonus breakfast club for you. We're going to do a live screen, sector specific. I'm going to look at three sectors: software infrastructure, utilities. Actually, it's software application. I changed it because when I was in infrastructure, I didn't like what I got. So I'm changing that to software application. Utilities and credit services, three different sectors. In two of those, the software application and credit services, a trend developing that I'll share with you. Remember, these ideas are use at your own risk. You can use them as trading ideas for trading the stocks. You can use them as potential income ideas for selling options. Uh, but I will take a quick look at a couple of these from a selling options idea just to see what things look like. I'm not going to make recommendations in that realm, but just to give you some general sense of what's available. Give me just a moment. I'm going to change my screen out. That should come up and be available to you now. So to give you just a quick um, baseline, uh, the core screening that I'm using here is starting over on the left side. We have price over $20, average volume over 500,000 shares, country USA. Just I'm not looking at foreign stocks right now. And is the stock optionable? Yes or no. On the fundamental side, I'm looking at profitable price to earnings ratio. That means the PE ratios are positive, whether it's the trailing 12 months or the forward price to earnings ratio. Either of these need to be profitable. I'm also looking for companies with 15% or higher EPS growth next year. And on the technical side, relatively simple here. I'm looking for stocks that are trading above both their 50 and 200-day moving averages, and stocks with a beta greater than 1. Now, the taking the market at large with this screen, you can see on the middle left side, I'll try to highlight it for you, 112 total stocks. That's sort of the universe right now that meets those basic criteria. And but what I want to do is I actually want to look at a couple of specific industries, and I'm going to start with utilities for a second. And I have to scroll all the way down off my screen to get this. I'm going to utilities, independent power producers. You can see that here in the middle of the screen. And I'm noticing again, limited numbers of or fewer companies coming up in some of these screens in different sectors. We'll continue to do this as we do weeks in the weeks ahead, even days ahead. But I really like both of these companies. Still, if we look at the chart, you can see Talon Energy on a significant run following all of the fallout in initial tariff news from the first to second quarter, but from a low of roughly 180, now trading over 260. Uh, what I like here, reasonable price to earnings ratios. 27 on the trailing 12 months, less than 20 on a forward price to earnings ratio. Uh, EPS next year versus trailing 12 months, pretty significant growth expected. Next year's earnings expected to double. If we look down here, we can see sales are starting to rise. This is a company which is starting to turn the corner into positive EPS, and I think those are the key points on that one. Um, may not necessarily be an optionable stock to me. I don't know that they have a significant amount of. You can see they don't. Right, there's not a lot happening on that stock, so I would not call that one an optionable. That one would have to be essentially a stock trade, um, stock detail there. So I would say we're back at the top here. I would wait to see if the stock comes back and retests the 240 line, maybe even the 220 line. But if you note here, follow this pattern. If you can see the screen, follow my mouse, the little hand here, right here. This little W pattern that developed, that line right there is 220. So that line was the breakout line. We've had three breakouts above, one, two, and then this one, three. So I would still expect the stock to come back and retest somewhere in that range. That's where I might look to buy the stock. I wouldn't necessarily want to jump, even though it's at highs. If we look at this on a monthly chart, you can see this is at all-time highs. That's a good thing. But from a capital perspective, I might want to wait to see if this comes back to retest a little bit before I hop in. On the other side, we had Vistra. Vistra is a stock we've traded frequently this year across income masters at a minimum. You can see that it is attempting to break out, but it isn't quite there yet. So one of the key things, one of the key factors on this stock, and some of the others we'll look at real quickly here today, note that at no point has the 50-day moving average fallen below the 200-day moving average. That's a sign of strength. You can see a sideways W that developed here. It's kind of like it's not a clear W, but that line 139 served as a breakout point. You can see it served as support and resistance here in early May. And then another negative earnings. This company apparently can't do earnings very well. Look at that, red, red, red. All of the E's at the bottom of the screen are all red. Maybe one day they'll turn green. I'll tell you what, if they do turn green, that would be a hell of a stock move. But right now, if we look again on a monthly chart, this is not a new company, but they've changed their business model. We can see that we're starting to challenge all-time highs. Not there yet, but again, on a trading level, I would have to look at least 160, maybe as low as the 140s, probably in the middle, right around 147 would seem to be a reasonable entry point if you're holding longer period of time. The stock is optionable. We have traded it successfully multiple occasions. I don't want to look at this week, so I'm just going to look at next week's for simplicity. But you can see there's certainly premium available at that 155 level at a minimum. What is that, 113? And these are pre-market prices, so pound of salt with a side of salt for these premiums. But on a premium basis, that's 0.0, that's greater than 0.5% in 10 trading days at the 155 level. So if I even going up a little bit, you're probably going to get closer to or nearly to, here's 1% plus, and here's just under 1%. So, even starting at the 157.50 on a put option, there's the potential for 70-ish cents if you take a 50% GTC in 10 days. That's not a bad trade. Of course, what's going to happen for income masters. Dave's going to come out and trade this, and then I'm going to, well, whatever. So there you go. There's an option idea for you on Vistra. Let's go back to the screener. And again, I want to come out of utilities. I'm going to go to a sector called credit services. One of the things that I have been following in the market, again, related to consumer behavior. How are credit companies doing? We have here MasterCard, One Main Financial. Capital One, Ally Financial, all are either key banks or obviously MasterCard credit card company. And then I found this company called SEZL. Never heard of it. But they, ironically, as a credit services company, they are in a fast growing sector known as Buy Now, Pay Later, or BNPL. It's not a stock symbol, it's just an acronym. Buy Now, Pay Later apps are gaining rapid traction um, among internet marketers that similar companies similar to ours, companies that are digitally based, they sell high or higher priced products or services, and what they are discovering is this area of buy now pay later is becoming a fast growing sector of their sales. And the reason for that is because the merchant that in my, let's say it was me, for example, and I'm selling a $5,000 service. Well, using these buy now pay later apps, PayPal has something very similar, right? You can break the cost of something down into payments, uh, not forced payments based on a MasterCard, Visa, or American Express, but payments that can be divided into two payments, four payments, five payments. I've seen some as many as 6 and 12. Uh, but the key and the reason that they're gaining popularity is because the merchant gets paid in full, and the credit service, the buy now, pay later, assumes all of the risk of the sale. So you recall I said a little earlier that this has the potential to be bullish or bearish. That's why it is bullish for the merchant, but it has the potential, if we fall into more recessionary conditions, to be bearish for the company that's buying the risk. Right? Think of it like an option. The merchant is selling the option to the buy now pay later company, right? So and the buy now pay later's uh, companies earnings, or they make their money on the interest of the payments or the payment plan. So let's take a quick look at this because the chart is shocking. uh, I mean, if you've heard of this company, please let me know because I had not until I did this screen. Um, but I want to start right here in the middle, down on April, the little purple S. The stock just split 6 for 1. So this stock was trading at $240 a share back at the beginning of April, or before, excuse me, the end of March, really. Mm. Blowout earnings. Here's May 7th, reported $1. The estimate was 20 cents. So they're doing something right, and they're certainly getting significant growth. Their revenue up over 60%. If we go back, that is here's 28% growth in revenue, 35 to 40% growth in EPS. So they're absolutely doing well. And again, another company where the 50-day moving average did not break the 200-day moving average. We are getting some separation here. Uh, Not a stock that I would say jump in and buy right now. I don't think I would try to get at least something, a little bit of a pullback here. I mean, at some point, this is probably going to retest this 100 line. You've got a small gap here, but it's kind of filled all the way back to the November period. Um, Generally, don't see companies give up all of these gains, but uh, at any rate, I mean, look, performance for the year, 800%. If you're looking for a stock that has the potential to move, apparently this is the one. It is a Russell 2000 stock. And again, strangely enough, reasonable price to earnings ratios, 45 trailing 12 months, 31 forward. That's roughly a 30% discount to future earnings. The only negative thing I found in this company, and it's, when I say negative, it's just from a mathematics perspective. No 5 year EPS expectation yet, in part because it's still a relatively new company. You can see they went IPO in August of 2023. And even in the depths of 2024 and volatility, the stock has held a fairly reasonable range. I mean, bearing in mind this is split adjusted prices here. Excuse me, but three bullish candles in March, excuse me, April, May, and so far in June. On the monthly chart, even on a weekly chart, you can see that a little bit better. I would call this, we've got to be reaching a point of exhaustion. So don't be surprised if we see a little candlestick develop, something like this, with a little bit of a pullback, maybe as much as 120. That would be nice. Does it have options? Yes, it does. Staying on the 620 expiration. Oh, that's why. It's only monthly. So even on the 620, I don't know that it has a lot of juice. Open interest seems fairly low. So for an individual trading this might be worth a look. I don't know that this is a stock as an option that we could recommend because it doesn't have enough open interest or volume at any of these levels. But I mean, here at the 100 level, a put, that's a 0.5% in 10 days. That's not that's not awful. Um, and that's 30% out of the money from where the stock is currently trading. That might be reasonable even at a 105 level. A 0.8% return potential in 10 days or fewer. So a couple of choices there for you. Finally, we're continuing this idea, this discussion on the concept of payments, et cetera. Let me go to one more sector. That sector is software application. Again, I have to go through the 400 of these things. Here's software application. Oh, that changed. Uh, no, it was software infrastructure. I was right. Sorry, I thought I changed it. I didn't change it. Um, if you've been around for the last couple of years, as I've talked about stock portfolios, you've heard me talk about shift four payments. Uh, this one is currently down. Note that its 50-day did cross, but here on the hard right edge, we can see that that 50-day is now moving back toward the 200-day as a potential break point. If you have a longer term view, this is a stock worth holding. Uh, Certainly a deep red bar there. Was that an earnings related? It was. Revenue, flat revenue, rising earnings. Here we had rising revenue, eh, average earnings. Those were high. They took a charge for something. So, um, but again, a channel building here, an uptrending channel building since the beginning parts of April. Uh, I like that. That's 70-ish, 70-ish to 95. So reasonable channel moving a little bit sideways right now. So you might have a reasonable entry anywhere around the, I would actually call it somewhere in the 85 to 90 range. Call it 80, 86. I wouldn't mind anything in that area. But for a stock, again, with an uptrend, this is a stock that has an all-time high up here above 120. So there is certainly potential for growth in the stock price. Um, and those are going to be all-time highs. Yeah. So you can see way back here in 2021, stock hit a high, bear market, little volatile, but starting to build again. That one works. I don't think this one is optionable, but we'll take a quick look. Again, monthly options only, very low, very low open interest. Um, and I think you would have to be too close to the money to get anything reasonable here. 87.50, 64 cents on 87.50 to 90 at $1.05. Those are your only realistic options as an individual. Again, I wouldn't make recommendations like these. Oops, sorry for that. I wouldn't make recommendations like those for a service. But back over here, see, we have Shift 4, Paymentus, another software payments system, and Toast. Uh, Toast is a restaurant app similar to uh, Stripe, similar to man, I can't think this morning. Anyway, uh, Block, but not Block. I'm blocked. I'm mentally blocked this morning. The Anyway, we can figure that one out. You can see this is recently broken out to new highs. This is also a newer issue, but it certainly did not fare well issuing right in the midst of a bear market. It has built off of a fairly strong and long consolidation period. So might be breaking back out. We're certainly at 45. We're at an inflection point. My concern on this one, however, really very high price to earnings ratio. So I would look for this stock to retest and pull back on the daily chart before jumping on it, in part because that feels too high. And it is trading at a discount to forward earnings, but they have to prove that they can hit those earnings. You can see that the stock on the EPS side, far left side on the lower part of the screen, has just turned over to positive earnings, so that's a good step. You can also see consistently growing revenues in sales. That's a good sign. So if you want a longer term stock, again, this one has not broken its 50-day moving average through all the volatility of the first half of the year. This is another one that I would say I might look at around the 42 level. You have a pretty solid line of support resistance dating all the way back to the November December period here. Early in February, some certainly resistance there. The breakout post earnings and support line that developed in just the last week and a half. So I would say somewhere anywhere between that 40 and 42 might be a reasonable entry. You could be greedy and try to get in at 36. That might be asking a lot. That would be a near 20% move lower. But I don't know about options, but we'll take a look. These have weekly options. So we'll just go out to next week's. No, that's this week's, my bad. Next week's options. Uh, Again, you have to be too close to the money. But look at this. Open interest, 6,600 at that 35 line. Much more open interest here than what we were looking at. So this might be a tradable stock, but there's no premium uh, below 41.50. So you're $3 out of the money. That feels too close, right? There's the 1% line. So the metric I use when I look at these is 1%, 50% good to close gives me a minimum 0.5% return. That's the math that I'm looking at. Just as a rapid assessment, because if you can close the trade anywhere between that 1/2 and 1% in a short space of time, that's a good income trade, right? We've used that metric with you for 15 years. So that's I didn't explain that, so I'll try to explain it there. But that's what I tend to look at is I'm looking for where's the 1% line, and then how close to the money is that. Obviously, you're going to have to be somewhat close, but this is intriguing. Why is there 6,600? We have look at this. It's 7,000 calls at 44. Call volume is not as high as, well, it is. It's a little bit higher, but it's not as consistent with this. Somebody's holding $25 puts, open interest. Somebody's interested in $25 puts. I don't know why. So those are gamblers, right? Those are gamblers way out there. But I wouldn't call these gamblers because that 36 line was right on the chart, right? That was right here. So somebody's anticipating trying to get puts at 36. So might be worth waiting to see if that develops. When is their next earnings? They just reported, so May, so June, July. They won't report earnings again until August, roughly. Um, Still like the stock. I still think the stock is meeting down here, right? It's meeting all of the conditions for a stock that's growing. We'll go through periods of volatility, absolutely, unquestionably. But as a longer term hold, this might be a stock that I will put on my list of stocks I'm going to check in on a regular basis. The last one, everybody knows Palantir. Don't need to talk about Palantir. Uh, Paymentus, look at that, nice run up, now sideways. So moving on a channel, smaller stock, so $36, reasonable stock. I mean, I might take the chance on that one. They don't report earnings as consistently. We've got earnings in May, March, November. I'm not quite sure how they report earnings, so I would need to look into that before I did anything. But down here, rising sales, rapidly rising sales from 2023 to 2024. Significant expansion of EPS on the right, on the far left side here from 18. They nearly doubled their earnings year over year. They're expected to more than double next year from prior year. In 5 years, 22% in the next 5 years. But they're not an index stock yet. They're just a New York Stock Exchange stock. If they get added to, and they would likely qualify for the Russell, I would think, yeah, below $1 billion in sales. If they get added to the Russell, this stock would probably get a lot more action. Uh, New issue in 2021. We are trading right at the tops, right at the tops, post IPO. Might look again for at least pull back a little bit, and that would be a good trigger, a good opening point. Again, I don't see any reason that the stock is going to collapse, but the last one, GoDaddy, I'm sorry, let me go back for 1 second to the screener here. So Toast, Paymentus, Shift4. The thing they all have in common is they are payment services. Shift4 and Paymentus are merchant side payment service providers, as is Toast. So along with SEZL, SEZL, which we just looked at, that's four different stocks in a small but very key sector, especially with digital sales are still the thing, uh, and the partnerships that these companies develop are driving their revenue higher. So these are four stocks you might want to put in your portfolio, sit on for a couple of years, right? If you have cash on the sidelines, if you're trading them, different approach. But I would be looking at these stocks for the longer term, um, not strictly on a short term. And then finally, GoDaddy, uh, mid channel right now from lows down here at 150-ish, highs up here at 210. But again, stock that has not broken its 200-day moving average. It is moving a little bit sideways. Uh, One of the things that GoDaddy has done has been to create more tools for digital businesses to build websites faster, including an AI development tool, uh, payment services, like we just talked about. Obviously, they're in the domain game. We host all of our, for full disclosure, we host all of our domains through GoDaddy. Um, but they have been growing sales rapidly, and the GoDaddy was one of the stocks originally on my 2023 stock list. 2023 might have been 2022. But at any rate, I caught a pretty long uptrend right here. So it would have been 23. I put them on 2020 in early 23. Nope, I'm sorry, 24. Yeah, last year must have been. No, it wasn't. No, it wasn't. It was 2023. Sorry, I'm just talking to myself right now. Please enjoy the music while you wait. Um, that's right. It was 2023 when I put them on on my in my full year portfolio, and I was mad because the stock was flat all year until they broke out in November and then blew higher into the end of the year, and I wound up with so we were somewhere right around here. Would have been late February. Late February. Yeah, it would have been late February. So around the 27th, 28th of February. So entry was somewhere, that's about right, somewhere around 77, $78. And I was just mad because the stock didn't move. And finally it did. It broke out at the end of the year, a big run up into the 100s. So I picked up, reasonable $30 per share gain. Um, but yeah, that's what I remember. And then I took them off and I should have left them on. So I wrong call on that side, but certainly some volatility right now. Uh, I don't know that they're not an AI company. Um, their AI developer is it's not the only one. Almost every business out there, Square was the company I was trying to think of earlier. Square offers an AI builder for websites. So do many of these other payment service companies, app payment service companies. So it's not a game changer specific to GoDaddy, but um, they are still one of the leading domain hosts and sellers, and they are simple and easy to use, which is one of their key features. As if you're new to trying to build an online presence, so I see a little bit of a trend developing slowly, but right now, if we look here, we can see flattening out a little bit. eh, might look and to wait a little bit on my entry, but if I'm anywhere in the, looking at this range right here, if I'm anywhere in this range, given that the company's oh, had an earnings miss, had an earnings miss there, and the stock went up. But you can see that generally speaking, they tend to beat earnings. We have 5-year earnings growth of 11%, so it's not going to be huge, but it's if it's consistent, that's better than the market. Uh, Reasonable price to earnings ratios, forward price to earnings ratio of 25 for a tech company. Those are all justifications. I know we've almost positive we've traded GoDaddy this year in Income Masters, but off the top of my head, no idea. But let's take a look here. Not much. A little bit more on the monthly side, but not much open interest. So it may not be tradable as an option stock. Could swear we traded it before, but maybe I'm wrong. Anyway, so there you go. That's a look at the basic a base screen. Pretty lengthy list of companies to look at. So the ones that I really like the most were TOST, and going back to utilities, Vistra and Talon, stock symbols VST and TLN. And finally, under credit services, take the long scroll, SEZL, stock symbol SEZL, um, as potential stocks for folks uh, to add to their portfolios. I see I have some questions. We don't have anything else going on for the moment, so let me see what we can do here. I read that Buffett indicator calculates that this market is 100%, 104% overvalued right now. Uh, I would not. I would agree with that. I think the market is clearly overvalued and is over the. Um, a thing to keep in mind is that Wall Street tends almost. I'm going to say almost always, but always drives the market to new highs before bear market or recessionary events occur. Um, the negative event tends to follow new highs in the market. Now it's not like the next day, but I, as I showed in valuation last week, I think this market is trading at 22 to 23 times forward earnings for this year with as much uncertainty as we have. Um, I think that yes, that it is overvalued. If it were trading 20 to 21 times, I would probably say no, that it's fair valued. But if we were trading at 20, we'd be trading 20 to 21, we'd be trading somewhere around that that 56 to 5800 level, which feels more comfortable to me from a valuation perspective. But um, the underlying issue of reducing forward expectations for the full year S&P 500 EPS from what was $277 per share down to $270 per share. That's not a small cut. That's a 3.5% cut in earnings expectations for this year. So just use that and multiply by 20 and you get 5,400, right? So fair value, typical fair value is 20. Anything above that is expansion of the market, or you just do a base multiplier of 20 times forward earnings. Um, Between this year and next year, where expectations next year are 280, you're looking at 54 to 5,600. That would be fair value. Now, it is okay for the market to trade at extended values for periods of time. We saw that in 2021, just prior to the bear market, when the stocks were trading at above 23 times forward earnings. So yes, I think the market is overvalued. Individual stocks, however, and I think it's David, um, Doug, if I remember correctly, uh, with the second question, ways that I'm looking for individual sectors. I'm looking for a story, right? So my story is, how are consumers going to continue to spend money given the levels of uncertainty we have had in the last 3 to 4 months? And one of my primary answers is that idea of buy now, pay later. Now, I went looking in credit services because I feel my sense is consumers will begin to rely more on credit as they have in the last 6 months in the next 6 months. So you have other potential moves for a Visa, a Mastercard, American Express, uh, the big banks, etc. Any of the financial services companies lending money, uh, with the exception of the housing industry, which we will look at in a week ahead here. But for general spending, right, general consumer spending, how are consumers paying for things? And these trends that are developing across uh, what is largely an underground space, meaning the mass media doesn't pay attention to the digital economy in my view, in the right way. They misunderstand it. If you recall, back in the 2010s, they called it the gig economy. Well, there are people with 10-figure businesses and nine and 10-figure businesses um, in these spaces. That's hundreds of millions to billions of dollars. And the mass media, CNBC, have no idea who these companies are. But the what links all of these companies is how they make sales, not from a marketing perspective, but from a payment perspective, right? So even for us, right, every one of our businesses has a payment infrastructure, right? We have a way to capture a credit card, charge the credit card, collect the credit card, collect the cash from the credit card. And that process, because full disclosure, I'm working on changing the infrastructure to how we collect credit card information, credit cards, credit farming, making it faster, simpler for people to check out. So as I've been doing this development on the back end of our own business, it has sent me down this ridiculously deep rabbit hole of what are other companies doing? How are people paying for things? You have the TOST app, the Square app. Stripe has a similar app. There are a number of these companies that, while they have buy now pay later features, they're also in the payment collection process as either as an app, as part of a website, as a service, etc. So that's one reason why I started going down this path. But what actually happened for me was when I went from credit services here and I switched sectors. I always check four sectors. There are four primary sectors that I always pay attention to, because they fit in the higher beta stock mode. And those sectors, you're not going to see them because they're off my screen. We'll start with this one: semiconductor equipment and materials. Well, look at this: zero. Zero stocks in semiconductor equipment and materials, meeting a very basic and simple screen of $20 a share or higher, 500,000 shares traded, positive PEs, positive earnings growth, prices above, and beta over one. We've got zero. So that's a concern. If we just look at semiconductor chip makers, right, we have a little bit more to work with here. 8 stocks, not much. But I'm not necessarily crazy about, although who is Astera Labs? So this is what happens. When you ask these questions, this is what happens. Another stock in between just recovered 50 days. So there's some rapid movement there. Solid base off 60. Back here, back in late fall, call resistance in the 50s. It's not consistent. Gap up, second gap up, gap down. That worries. Way out of control price to earnings ratios, though. EPS this year 60, next 5 years 40. Negative earnings right now. So if the company is going to flip to positive earnings, that would imply some of the movement in the stock. But doubled sales, so that will translate to earnings at some point if the company is well run. Not on an index, so definitely something to keep an eye on. Marvel Technology, Power Integrations, Lattice Semiconductor, and Monolithic. So they've got some competitors. Broadcom, certainly Broadcom is a major competitor. I wouldn't worry about Intel. Intel's dead to me. AMD. So anyway, so there's another stock, right? But so that's how I start. I usually start looking at semiconductor equipment and materials and semiconductors, and then I look at software application and software infrastructure. And the reason is because with technology being as ubiquitous, even invasive as it is, they are four cornerstones to foundations to technology. So equipment and materials, it's how you build chips, semiconductors, building the chip. Software infrastructure is how you use the chip, and software application is how the chip is used. As a brutal oversimplification of four key areas of the technology market, but that's usually where I start. Well, when I was asking on the consumer side, I'm like, well, what's happening in credit services? That sent me down, and I discovered SEZL, and it was SEZL that sent me down this next path of software infrastructure, which got me down to TOST. And somebody, did the market open? The market opened, so somebody fell off. Shift four fell off of our list for the moment. Excuse me. So then I started to see the trend across these different companies, and coupled with what I know about the digital business environment, simply being a part of it, that's how I started moving along in the sector range to look for specific stocks. So we'll do some more stuff with, my goodness, consumers, uh, housing, uh, and some other key sectors in days, weeks ahead as we go through this month, next month into earnings period. So uh, anyway, that's it. A lot longer than we expected, but I hope you pulled something from that. Um, and again, a very good week in closeouts last week. Let's hope we have a favorable market. Let's see where we are opening. Nope, opening flat. Okay, no big deal on that. Let's go down and see. Wholesale inventory is at 10 a.m. That's not going to do anything. So market's opening flat, slightly higher on the Russell, but pulling back. Dow down, NASDAQ up, doesn't count. S&P flat. So that's okay. So we're going to be dancing around the 6,000 line. Uh, and data this week is going to determine whether we're going to break above or break below. That's how I see things happening for right now. Anyway, thank you for joining me. Let me unwind everything here, and we will be back next week on Monday, June 16th at 8:30 a.m. A reminder that this Friday, June 13th at 10 a.m. will be the inaugural trading assistant with Jeff Wood, assuming Jeff's plane has landed safely. So Jeff will be back with me next week, and we'll see what we can dive into with the next Breakfast Club. Outside of that, thanks for joining me. I hope everyone has a great day, and we will see you if you're an Income Masters member, we'll see you at 12:30.